Hey, what's up? What's up, my friend? So, in this video, I want to share with you the truth about Forex trading. Warning, right? This video isn't a video that will make you feel good, right? Talk about how you can go achieve your dreams, right? Travel around the world, drive a Lamborghini, right? Attract the hot chicks and blah blah blah. No, none of that. In fact, the truth hurts, right, as they say. So in this video, I'm going to share with you, right, what it takes to succeed in this business and to manage your expectations. So if you are someone who wants to feel good, this video clearly isn't for you. But if you're someone who wants to know what it takes to succeed in this business, right, and how you can actually shortcut your learning curve, all right, then this video is for you. Okay, so the first thing first, number one, the first question I always get is, how long does it take to become a profitable trader? And from what I've seen, right, I've seen traders who became profitable in less than a year. I've seen traders who took 4 years, 5 years, and I've also seen traders who spend 10 over years and are still not profitable. Okay, so from what I've seen, right, as a general guideline, proprietary traders, they typically become profitable within a short period of time because, number one, they're trading off the lower time frame and they have more trades to take. And with more trades to take, right, and you have a proven framework to follow, like constantly review your trades, tweak and improve, right, you can achieve, right, much more results within a short period of time. So this is why prop traders, they typically, right, get profitable within the 1 year mark. But that is not to say that prop trading is the best way to go about, because the attrition rate is also very high. So I'm just talking about those traders who does make it. But those traders who don't make it, again, the percentage is very high. And from where I came from, about 9 out of 10, they don't make the cut. Okay, so now what about traders like you who are watching this video? You probably have a full-time job, right? Trading something that you do on the sides, maybe to generate an extra income, maybe to help you grow your portfolio over time. How long does it take to become a profitable trader? And based on what I've seen, right, a rough guideline is about 4 to 5 years. And the reason why I say that is because most traders, right, would go through a similar route. For example, in the first year of trading, you get excited. Oh, right, trading, man, I'm going to make it big, right? I'm going to drive the nice, fast cars, quit my full-time job, and you learn all you can about trading. And in the first years, you learn, technical analysis, fundamental analysis, sentiment analysis, and after which you find that, man, this is so much knowledge, right? I'm always acquiring so much knowledge, but my trading results is not improving. Why is that? And that's where you have your first aha moment, is that you don't need to know everything in the markets to make money. Okay, so this is where, year 2 and year 3, you start to discard all this knowledge, right? Start to, kick out the 90% of the fluff that doesn't work and just focus on the 10%. Okay, so now once you're left with that 10%, this is where you apply proper risk management. You have a better expectations of your trading. So in year 4 onwards, right, is where you start get serious about trading, to trade with stuff that has worked for you, and from then on, right, you have a good chance, right, or you have a chance of becoming profitable from then on, right? So you can see that this is a path that I think most of us will go through. I went through that path, and if you ask me, right, most retail traders, if you are the type of traders who are starting from blog posts, forum, reading books, on average, I would say it take about 4 years plus. Okay, so that's the truth. Second thing, how much money can I make from Forex trading? All right, can I quit my full-time job and travel around the world and just click on the laptop and make $1 billion? Well, here's the truth. So to determine, right, how much money you can make from trading, there is 3 things that you need to bear in mind. Number 1 is your average win rate. Number 2 is your average risk to reward. And number 3, very important, is your frequency of trades. This is something that a lot of traders, they neglect. So let's say, for example, there are 2 traders, John and Sally, right? Let's say they both have a similar expectancy. They both have about 50% win rate with an average of 1 to 2 risk to reward. Which trader is going to make more money? Well, you have to ask yourself, which trader has the most frequency of trades? Let's say Sally has 50 trades a day. She's a scalper. Whereas John is a longer term position trader. He has 50 trades a year. Clearly, right, Sally is most likely right, to make more money than John, because she has a higher frequency of trades, and given that their win rate and risk to reward, right, on average are the same. So she's going to make more money because she has more trading opportunities, right? So how much money can I make from trading? Again, you have to take into consideration these 3 factors. Okay, and also you have to take into account, right, your risk per trade, your percentage risk per trade. Needless to say, if someone who risks 2 or 3% of their account on one trade has a good chance of making more money compared to someone who risks 0.5%. Okay, but at the same time, they are also going to have a deeper drawdown. So you can see that a lot of things all it depends. I hate to, give you the answer, it depends, but it's the truth. It really depends on a lot of factors. But if you really want a hardball figure to how much you can make from trading, generally, day trader or shorter term trader, you can make anywhere from 50 to 100 R per year. Whereas a longer term trader, swing position trader, you're looking at anywhere between 20 to 40 R per year. Okay? So that's my answer. Third thing, right? Are trading indicators useless? Hey, Rayner, I heard that indicators are lagging. That means they're useless. Is that true? I would say that traders who say that indicators are useless, alright, typically don't understand how indicators work. That's why they say it's useless. I would say indicators, they are not useless. Yes, they are lagging. Indicators are lagging. I agree. But in fact, everything that you see on your chart, your candlestick pattern, your chart patterns, they are all lagging as well, because it all has occurred after the fact. After the price closed, then your candlestick is formed. They are lagging, right? So just because something is lagging doesn't mean it doesn't work. Okay, why do I say that? It's because, for example, if you look at the chart, right, you see the range of the bars up and down, up and down. Can you tell what is the volatility of the market at one glance? Chances are you can't, because you have to start to pay attention to the range of the bars. Is it constricting? Is it expanding? Is it getting smaller again? But if you pull out an indicator like the average true range, you can look at it at a glance whether the volatility is expanding or contracting. So this is something that an indicator can do that price action would have a little bit more difficulty, trying to visualize it. So indicators, they are useful because it helps you visualize price action. It helps you summarize the price action. Okay, so for example, another one is moving average. You can't tell whether the longer term trend is up or down. Just pull out a moving average like the 200 period moving average. You can tell at a glance, right, whether the longer term trend is up or down. If you want to see what's the short term trend doing, you can just pull out a 20 period moving average, a shorter term moving average. Whereas you just look at the charts, right, you want to ask yourself, what is the long term trend, the medium term trend, and the short term trend? I can tell you will get confused, because you start to ask yourself, what is the trend? Do I zoom in, zoom out, and stuff like that? Do I look at the last 20 candles, the last 50 candles? You can see that there's a lot of so-called subjectivity to it, and you will have difficulty, right, even answering a simple question like, what is the trend? So this is where a moving average, a very simple indicator, it lags the market, could give you a better answer, or could give you a quicker answer, right, compared to someone who just stare blankly at the chart and have difficulty identifying the trend, right? So indicators, they are not useless, right? They are only useless to those who do not know how to use it. Okay, the fourth question, which is the best trading strategy to trade X market? So often I get question, hey Rayner, which is the best strategy to trade crude oil? Which is the best strategy to trade MCX? To be honest, I don't really know what's that, right? So here's the thing. I am always very careful, right? Or I will be very aware whenever a strategy only works on one market. Why is that? Two reasons. First, number one, chances are that strategy is curve fitted to whatever historical data that you put on it. And number two, if a strategy only works on one market, that particular edge that you have, let's say, chance by accident, can be easily eroded, right, by a trader who has deeper pockets than you, or an algorithm who can just take advantage of this inefficiency. So this is why I'm always very careful, right? And I don't like, right, to trade a particular strategy that only works on one market. Let me share with you an example, or rather a story, right? Back when I was a prop trader, right, one of the things that the traders at the floor like to do is that they like to trade the Nikkei futures contract, because Nikkei is traded on a multiple exchange. It's traded on the Osaka exchange, the Singapore exchange, and even on the CME exchange. So one of the so-called beauty of it is that if it's traded on multiple exchange, there is arbitraging opportunity. Let's say, for example, Nikkei right now is trading at $100 on SGX. And on the Osaka exchange, it's trading at, let's say, $105. What I can do is I can short the Osaka exchange, short the contract at Osaka, and long the contract at SGX, and profit the difference of $5. So that is the general idea behind it. And in fact, in the early days of so-called trading the Nikkei contracts, there are a lot of arbitraging opportunities like this, because the markets are not as efficient back then. So this is so-called like, one specific strategy that only works for Nikkei because it's traded on multiple exchange. And what happens? Well, fast forward a few years later, when the algorithm comes into the market, the machines are faster than humans, this edge is gone. And a lot of traders that have made millions of dollars during that era, they can't trade anymore because their edge is no longer there. So this is why I say that, you really want to be aware if there's only one particular strategy that only works in one market. Because chances are, okay, that strategy, right, the edge, right, can be eroded easily. Okay, so this is why I choose, right, to trade with strategies, right, that number one, either adapt to different market conditions or works, right, across a broad basket of markets. Like trend following, it's applied across a portfolio of markets. Or price action trading is where you read the price action of the markets, you identify the market condition, and then use the appropriate strategy to trade that market condition. So these are the type of strategies I would rather trade, rather than finding a best strategy for X market. Number two. Oh, sorry, this is number two. This is number five, right? When is the best time to enter a trade? So again, this you probably hate to hear this, but it depends. Why do I say that? Because if the market is in a range, well, then the best time to enter a trade is buying low at support or shorting high at resistance. If the market is in an uptrend, then it makes sense to, let's say the market is in an uptrend, a healthy trend respecting the 50 MA, then it makes sense to buy the pullback, maybe the pullback towards the 50 period moving average. If the market is in a strong trend, okay, then it makes sense to be buying the breakout. So it really depends, right, on the market condition. And then you use the appropriate entry technique to trade that particular market condition. And that's, unfortunately, right, markets are always changing, and that's why there really isn't a best time to enter a trade. Next, right, which is the best time frame? Okay, so I get this a lot as well. Hey, Rayner, which time frame should I be trading? Which time frame is the most profitable? So again, there isn't a best time frame, because why do I say that? Because you have proprietary traders or short-term traders. You're trading off the 5 minutes time frame, the 15 minutes time frame, and scalpers, they don't even look at time frame. They just simply trade off the order flow, the bids and offer. At the same time, you have swing traders who operate off the 1 hour and 4 hour time frame. And then you have, longer term position traders, trade off the daily time frame, or even, like mutual fund, hedge funds entering off the daily and weekly time frame. So you can see that across the board, across the different time frames, there are different group of traders operating on it. And this goes to tell you that there isn't a best time frame out there. The best time frame for you is a time frame that you can commit to. If you have a full-time job, this means that you want to be trading off, let's say, the daily time frame, where you come home from your work, right? You can check the charts, right, and make decisions off the higher time frame. It doesn't make sense if you have a full-time job and you're trading off the 5 minutes time frame, because you don't have the time to commit to that 5 minutes time frame. So the best time frame for you is a time frame that you can commit to. Okay, moving on. Will high-frequency traders erode my edge? So earlier you've seen that high-frequency traders, they have actually eroded the traders who trade the Nikkei futures. All right, so I would say high-frequency traders, you should be aware of them if you are trading off the lower time frame. If you're a scalper or a day trader, right, where speed is of the essence to you, they could possibly erode your edge, right? High-frequency trader could possibly erode your edge. But if you're trading off the daily time frame, the 4 hour time frame, I wouldn't really worry about it, because you guys, right, are operating on different time frames. Okay, so it's like saying, right, a new multi-billion-dollar hedge fund is coming to the block, right? They are trading off the daily time frame. If you're a short-term trader like the 5 minutes time frame trader, would the hedge fund affect you? No, right? Because you're trading off a different time frame, and it's the same as high-frequency traders. You're all operating on different time frames, so you don't have to worry about it unless you yourself, right, are a short-term trader. You're a high-frequency trader, then hey, this is something that you might have to consider about. But generally, most of you watching this video, you're not even, a scalper or a day trader. So the general answer is, high-frequency traders, they won't erode your edge. Okay, next one. Should I quit my full-time job and trade full-time? Should I quit my job and trade full-time? All right, so the answer to this, right, is probably no, right? It's because, right, you don't want to, leave a comfortable job and trade full-time unless, right, you have proven to yourself that you can consistently profit from the markets. Because the fact that if you're asking this question, right, it's probably means, right, that you're not even profitable yet. And if you're not profitable yet, why do you want to leave your job and trade full-time? That only stack the odds against you, because now you have lose that fixed income stream, and on top of it, right, it makes it harder on you psychologically, because you have the need to make money. So why do you want to do that? So generally, my suggestion is, if you want to, quit your job and trade full-time, you need two things. Number one, enough capital. I suggest at least a minimum of $100,000 to start with, right? And again, right, it also depends on the expense you have. The larger your expense is, right, the more trading capital that you need to generate a return to meet your lifestyle. Second thing is, you need to be able to prove to yourself that you can consistently profit from the market. If you have been losing consistently, right, it's not going to make a difference whether you're trading full-time or part-time, because you're still going to lose, right? You need to nail down the process, right, that framework, to prove to yourself you can do it. And then, hey, maybe you have a chance, right, if you were to do it full-time, at the comfort of your home, no one to answer to, and yada yada, right? But first, right, you have to meet these two things. Number one, your capital requirement, and number two, that you can, right, be a consistently profitable trader. Okay, next one, right? When is the best time to exit a trade? So the thing about trade exits is, again, it really depends on you. What are you trying to accomplish? Let's say, for example, if you're a swing trader, you just want to capture one swing in the market. Let's say, the market is in a trend, you buy the pullback and it moves up higher, right? Retesting this highs, and you just want to capture this one swing, right? Then it makes sense, right? The best time to exit the trade is just, before this swing high over here. But if you're a trader that, let's say, you want to, ride long-term trends, right? Trend following, right? The market is in a trend. Then the best time to exit a trade is when the market shows sign of reversal or when it hits your trailing stop loss. So if the market shows signs of reversal, right, breaking below this low, for example, then hey, right, this might be a time for you to exit your trade using whatever trailing stop loss mechanism or technique that you're using. So that is the best time to exit your trade if you want to, ride the trend. So the first question that you have to ask yourself is, what are you trying to accomplish? To ride a trend or to just capture a swing? Once you've answered that question, then you can use the appropriate technique, right, to meet your goals. And finally, which is the best indicators settings, Rayner? Should I use the exponential moving average? Should I use a simple moving average? Should I use a weighted moving average? My answer is it doesn't matter. Why do I say that? Because there isn't a best indicator settings. Likewise, there isn't a best indicator out there. Say, for example, you're looking at the chart and you realize that the 20-period moving average is, respected by the market. Always, bounce off, come back, bounce off to the pip, right? So the 20-period moving average seems to be the best indicator settings for this time frame, for this market. But guess what? Markets always change, right? It doesn't mean that it's going to respect the 20-period moving average forever. It's going to break down eventually, and the moving average will so-called be rendered irrelevant. So this is why there is no such thing as a best indicator settings out there, because the market always changes. So don't ask yourself, for this, let's say the Nifty 50, right, which is the best moving average to use. For the crude oil, which is the best moving average to use, because there is no such thing as a best settings or best indicators to use. What's important is to ask yourself, what is the purpose of your indicator down there? And then use that indicator to meet your goals. For example, I use the average true range indicator. What is the purpose of it? Is to help me measure the volatility of the markets. Okay, so to measure volatility of the markets, what is the time period to use? So since I'm trading off the daily time frame, I know 1 month has about 20 candles. I use a 20-period ATR. Do I use the simple moving average or the exponential moving average? Doesn't matter. It's not gonna make a difference, right? The concept that I want is just to measure the volatility of the market and add some buffer to my stop loss. That's what I'm trying to do. Whether it's EMA, SMA, WMA, doesn't make a damn difference to me, right? The figures could change by 0.5, 1 point or 2 point. Who cares? The concept I'm trying to have is to determine what is the buffer that I want to use to add on to my stop loss. That is the core concept that I'm concerned with, not the best parameter, not the the range of candles that I want to look back across, right? No, the concept is what matters, and this is what I keep telling traders. Always focus on the concept, not on the best indicator settings, parameters, or whatsoever. Okay, so there is no best indicators out there to answer your question, and there's no best settings as well. Okay, so yep, that's pretty much it, right, for this video, right? I've shared with you the 10 truth about Forex trading. I hope this gives you insight. I hope this gives you something that you can chew on, to think about, and hopefully, help you move your trading towards the next stage. I don't want to see, to see you trap around in circles, running around and around, trying the different indicators, different settings, and don't have any results to show for. Because like I've said, right, those are really stuff that you shouldn't really focus on. I think the process is so much more important than, finding the best parameters, indicators, settings, or whatsoever. Okay, so with that said, I've come towards the end of this video. If you have any questions, feedback, let me know in the comment section below. And if you enjoyed this video, hit the subscribe button, hit the thumbs up button, right? I would really appreciate it. And with that said, I wish you good luck and good trading. I'll talk to you soon.